What is APR on a credit card? APR stands for Annual Percentage Rate and represents the cost of borrowing money. With a credit card, the higher the APR, the more you can typically expect to pay in interest if you finance your purchases. To determine APR, many credit card issuers start with a financial index, such as the U.S. prime rate. Then they add a margin of percentage points to determine their particular annual percentage rate. Generally, credit card applicants with good credit are offered lower APRs than those with credit that's not so good. There are 3 types of credit card APRs. A fixed-rate APR is established when the card is issued and typically doesn't change. However, it could change under specific circumstances, which should be outlined in the cardholder agreement. Credit card issuers must provide card members with advance notice of any changes to a fixed-rate APR. A variable rate APR is also set when the card is issued, but it fluctuates with changes in the financial index to which it is tied. So, if the U.S. prime rate rises, a variable rate APR would likely rise accordingly. A promotional APR is valid for a limited amount of time and applies to specific types of transactions. For example, a credit card may offer a 0% promotional APR on a balance transfer up to a set amount. Your credit card's APR is used to calculate the interest added to your card balance if you do not pay the entire balance owed by the payment due date. And if your credit card does not have a grace period, you will be charged interest at the designated APR even if you do pay off your balance each month. Annual percentage rate does not mean the interest rate you pay once a year, because you don't just pay interest charges on a credit card once every year. But annual percentage rate is used to determine your daily interest rate, which is used to calculate the interest charges listed on your statement. The amount of interest you pay each billing statement is determined using this daily interest rate, which is multiplied by your average daily balance. Average daily balance is calculated by taking your account balance at the end of each day of your billing cycle, adding these balances, and then dividing that sum by the number of days in your billing cycle. So, say that for a 30-day billing cycle, you had an average daily balance of $400 and an APR of 20%. Your daily interest rate would be 20% divided by 365, the number of days in a year, which equals 0.0548%. The amount of interest you would be charged for that billing cycle is then calculated by multiplying your average daily balance by the daily interest rate, which equals 22 cents per day. Then that amount is multiplied by the number of days in the billing cycle, which in this case is 30, to determine the amount of interest charged for the billing cycle, which is $6.60. While APR plays a role in selecting a credit card, it's only one factor to consider. You may also want to consider the card's credit limit, fees, does it offer rewards on purchases, and other perks, to name but a few. If your credit card has a grace period and you pay your balance in full each month, then the card's APR may never even affect you. On the other hand, if your credit card does not have a grace period or you don't pay off your balance each month, then its APR will influence how much interest you pay. In this case, a card with a lower APR may make better financial sense for you.